Hey everyone, welcome back to Finance Sphere. So, at the late July FOMC meeting, the Federal Reserve decided to hit the pause button and keep interest rates unchanged. Right after the announcement, we saw a classic relief rally. The dollar index dropped and bond yields slid as the market shook off some immediate fears of tighter policy. Why the sudden relief? Well, right before the Fed's decision, Citadel caught markets off guard with a report predicting a shock rate hike at this very meeting. When that hit the headlines, risk on assets like equities and crypto took a heavy hit. Naturally, the actual pause brought a swift wave of relief. But as the voting breakdown, the FOMC statement, and the press conference unfolded, market anxiety started creeping right back in. Forget about rate cuts. Three members actually dissented in favor of an immediate rate hike. On top of that, fears are mounting that inflation remains stubbornly elevated, with central banks worldwide, like the ECB, BOJ, and Reserve Bank of Australia, moving toward tighter policy. Global hawkishness is rapidly picking up steam. And this Fed vote, it just poured fuel on that fire. Now, looking at recent inflation prints, June CPY actually came in cooler. As you guys know, oil prices shot up earlier due to escalating tensions in the Middle East, ramping up inflationary pressure across the board. But as things settled into a prolonged stalemate, crude pulled back, and that temporary dip was reflected in June's numbers. The catch? Middle East tensions have flared up again, pushing crude right back up. That means the July inflation print we get in August is very likely to rebound. As I mentioned in my last video, markets historically tend to pull back about 2 to 3 months after a new Fed chair takes office. Combine that with heavy Treasury issuance hitting the market in August, extremely weak seasonal tailwinds for risk assets in September, and the Treasury's aggressive plan to rebuild its TGA balance in Q3. Taken together, these developments suggest that we need to be extra cautious and manage risk with extreme discipline from mid to late August right through September. Looking at how markets are pricing this Fed pause, traders are banking on a rate hike around September or October, followed by another one right after the U.S. midterm elections in November. Even though the Fed paused this time, the narrative completely dominating the market is that rate hikes are right around the corner. So, what's Warsh's game plan here? During the press conference, he pointed out that even though he has yet to make a policy move in his first 42 days as Fed chair, the market has done the heavy lifting itself, driving up nominal and real yields and tightening financial conditions on its own. In fact, if you look at the recent move in the 10-year Treasury yield, we saw a classic bear steepening, with long end yields surging and widening the yield curve spread. Kevin Warsh signaled that forcing down aggregate demand through rate hikes to forcibly align it with constrained supply, the old playbook, isn't his model, especially when the market is already tightening on its own. He highlighted that massive capex from AI companies could boost U.S. productivity and supply capacity, meaning we need to be cautious before drawing firm conclusions about the economy. He added that right now is a period for assessing whether further hikes are even necessary, and if so, when the right timing would be. To me, this actually struck a subtly dovish tone. He explicitly noted that hiking rates isn't the silver bullet for taming inflation. The current price spikes are supply side shocks driven by geopolitical chaos in the Middle East, and increasing interest rates doesn't expand crude oil supply, so other policy options must be considered together. In short, inflation is sticky, but he's in no rush to slam on the brakes with immediate rate hikes. He emphasized that he won't panic or overreact to a single CPI print. Instead, a dedicated internal task force is gathering a wide range of private sector data alongside CPI and PCE to get a clearer read on underlying inflation. More importantly, he stressed that maintaining the market's trust in the Fed's commitment to its 2% inflation target matters far more than any single rate decision. Overall, Kevin Warsh seems determined to play it right down the middle. He's staying completely neutral, refusing to feed into market expectations or swing aggressively hawkish or dovish. Even though bond markets are pricing in higher inflation with rising yields, he didn't give in to those expectations and kept rates on hold. Nor is he feeding into the dovish hopes of him being a Trump-appointed Fed chair who would aggressively slash rates. He drew a clear line in the sand. The Fed's job is to make policy decisions to promote price stability and maximum employment, not to rely heavily on forward guidance or hold the market's hand. Look at the length of the FOMC statements. The change is night and day. Last year, statements averaged around 2,100 characters. By June, that shrank to roughly 840 characters, and July's statement was even leaner. Scrapping forward guidance might be his tactical response to a market that's already front-running inflation fears and doing the tightening for him. My take? He wants to firmly re-anchor inflation expectations before revealing his broader policy strategy. Warsh also hinted at Jackson Hole in late August, mentioning that his task force is actively researching how to revamp the monetary policy transmission mechanism. That speech will likely be the ultimate make-or-break moment for the trajectory of the September FOMC meeting. That's a wrap for today's breakdown. If you found this analysis helpful, please smash that subscribe button, hit the like button, and turn on notifications. Thanks for watching, and I'll see you guys in the next one.